three.
Morning.
Good
Good morning. Good
morning.
morning.
Good morning. Good morning.
Good
Good
morning.
Good
Good
morning.
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 Good morning. Good morning. Great morning. Happy
Morning.
Saturday.
Good
Hey,
morning.
everybody.
All right. Well, hey, everybody. Welcome to Vantage Saturday. I get to be your host today. Dan and their wonderful team are having an event out in California. So it's going to be maybe a little smaller meeting, but I promise we're going to give you a lot of golden nuggets and a lot of information today that you can actually use. You know, I've been in this industry 26 years. I got introduced to it when I was just turning 20 years old. And I remember coming into the financial world, and frankly, it was scary, right? Because it was not my background, right? My background was computer programming. Um, I knew what a savings account was and a checking account, right? Those are products that I heard, like my maybe my aunts and uncles talk about, my mom, right? So, but I never knew anything about the stock market. I had heard of it, right? And it sounded kind of cool. And if you know anything about like the 90s, the stock market was really hot, right? People were making good money in the market. And I was just like, man, I'm curious, but I felt a little dumb, honestly. Like I don't know where to go, who to ask. Back then, we didn't have all the applications and YouTube videos and the information like there is today, right? If somebody wanted to learn about any topic today, you can use AI, you can go on YouTube. In fact, you know, you had to go read books, you had to go talk to a stockbroker, right? I remember like you couldn't do a trade. A lot of people show me the Robinhood app, and you know, I got this app and this app, and I'm buying stocks or I'm buying ETF. Which, by the way, most people never be intimidated by those folks, right? Most of them are guessing, right? They don't actually do research and figure out which is the right stock. Am I buying it at the right time? What is the ratios and so forth? They're just kind of guessing. They're looking at momentum and so forth. So don't be intimidated. I when I started, I would be, right? Because I'm like, oh my God, that person seems like they know more, right? But it took me going to a lot of classes and learning how to take this complex world of finance and simplify it, right? I had great mentors and people that said, Albert, it's not that difficult. Look, let us break it down into ways that you can understand it. And part of what we're going to do this morning, I'm going to kick it off here with my good friend, Richard Lamb, is show you some tools we've created along the way, right? That have been effective, that get us results, right? Richard is great at closing business, right? People are always like, wow, he's always closing business. He's always got clients, right? And he's like, well, he has a teaching background, right? And you know, for you to be effective, you got to take something that's complex and make it easy where people understand it. I find that if people understand what you're talking about, they're likely to move forward with a decision, right? When you confuse people, or one mistake I did when I was, you know, early in my career, I try to sound real smart, right? So I would go dig into people's 401k statements and show them expense ratios. Like I was a little bit of a nerd because I wanted to, I guess I was scared that somebody would ask me a question that I didn't know the answer to. So I would go in there and dig and spend hours with people trying to educate them about finances. And what I found over, you know, over time was that people were confused, right? And they're like, you know what? Let me think about it, right? Who's ever had somebody that says, let me think about it, I'll get back to you, right? Well, what you're going to learn this morning will help you avoid those scenarios, right? Simplify it, let people understand it, have them have a good experience with you. And then I'm going to conclude with how to get referrals. One thing I have been in my 26 years is consistent, right? I've never knocked on a door. I've never had to cold call. I make sure my clients have a great experience with me. And, you know, anytime we have a great experience anywhere, right? You go to movies and you have a great time, or you go to a show and you have a great time. What do? You want to share that experience with your friends and family and people that you love and care about, right? So I'll show you some tips and pointers. So if you don't have some teammates on here and you need them to get better at referrals and gathering more business and have people open up doors for them, make sure they get on. But I'm going to turn it over for the first half to my good friend, Mr. Richard Lamb. Rich, are you there? There you are. Let me see
Yes.
you.
Good morning. Can everybody hear me?
Yes. Good morning.
Awesome. Awesome. Happy
Yes.
Saturday
Yeah,
morning,
yeah.
Vantage
Morning.
family. So glad to be here this morning. operating out of my mobile office this morning. Had to drop my daughter off, so I said, okay, I don't have time. I got to get on Zoom. So happy to be here. Couple things what Albert said. I hope you caught some golden nuggets. What he said, right? I have a teaching background, and early in my career, every time I sit in front of my client, I would take out a notepad, I would draw things out, right, explain things, and it would take a lot of time, right? And after a while, I'm thinking like, why do you got to do that? Why don't you create some worksheets, right? I was a high school math teacher and I created worksheets, so why don't you create some worksheets and then use it all the time, right? And one of my mentors once said, if you have a problem, turn it into a procedure and it won't be a problem anymore, right? So my problem was I'm redoing the same thing over and over again. So let me turn it into a procedure, right? Create a worksheet and then just walk through the worksheet, and it's going to save me a lot of time. And then afterwards, my clients usually ask me to keep the worksheets, right? It's like, hey, can I keep your worksheets? And I said, absolutely. And I find that, like what Albert said, was when you have an educated consumer, right? When your clients are educated, right? What happens, right? They're a lot more comfortable. They're going to move forward with the product. They're going to keep the product. And not only that, right? They're going to talk and they're going to share more about it with their friends and family. So that in turn is going to generate referrals, right? Which Albert's going to get into later on. So I'm going to share 3 worksheets with you this morning. I have a bunch, but I'm going to, and I can share more later on, right down the road. But today, this morning, I'm going to share 3 worksheets. 2 of them, all of them have made me a lot of money, right? And not only that, but my clients get educated. And I try to keep it simple, right? They say you want to simplify to multiply, right? So let's get started. I'm going to start my timer here. I want to make sure Albert gets enough time and share my screen here. All right, can everybody see that? Raise your hand, give me a thumbs up.
Yes.
All right, awesome. So the first worksheet I'm going to share is the dime method. Now, those of you who are new, all right, this is a method, a simple way to help a client, right, a family figure out what is the right amount of life insurance to have, right? Because most people, most families, and those of you who have some experience can attest to this, right? When you sit down with a family and you ask them how much life insurance they have, what do they usually say, right? 250, 100,000, or all I have is what I get through work, right? And usually, that's well, is that enough, right? If you have a family, you have debt, you have homes, and you have children, is $250,000 enough to leave behind for a family if you're the breadwinner, especially? Not at all, right? That might last a few years and then that's it. And then the family is going to be struggling, right? So it's critical that we help families figure out the right amount, right? First. So this method's called DIME, right? Well, let me just start with the worksheet. So I would take this worksheet out in front of my client and said, let's talk about life insurance. I'm going to educate you today on that, but let's help you figure out what's the right amount to get first. And I would just gather some information, right? Because later on, I'll show you after I go through this worksheet and the second one, that usually leads me to running quotes, right? Do an illustration. So I gather this information beforehand. So I get their name, right? Male, female, smoker, non-smoker, date of birth, number of children, ages of children, health, if they have any health issues, medications, annual income, and just give me, I would say, do you have any idea what the budget would be, right? Just an idea. And I gather this information and I'll say, let me show you a quick, simple way to figure out how much life insurance you should have. And DIME stands for, right? It's an acronym, DIME. D stands for debt. So I would say, let me give you an example first, and then we'll gather your information afterwards, right? So here, I'm just going to walk them through an example. So I would say, here's an example how we use DIME. Let's just say a client has $50,000 in debt, right? I would put $50,000 right here. And I would ask the client, well, how much do you earn per year? If the client says 75,000 in this example, and I would take 75,000 and I'll multiply this by 10. And I would tell this to the client. I'll say, I'll get back to you and explain why I used the number 10. We multiply by 10. And I would say, how much you owe on the house, right? How much is left? And they would say, oh, 300,000. Great. Put 300,000 down. And you have a couple of kids, right? How much how much would you like to save for college education, right? And I say, here's an example. Let's just say 200,000. So what we do is we add up all these numbers, and the total in this case is 1.3 million. So I would say, Mr. and Mrs. Client, you need about $1.3 million total coverage. Okay. And based on what you told me. And here's how it works. I said, if you were to pass away, your spouse or your beneficiary, in this case, can take this money. By the way, the death benefit is tax-free, right? So you would get, your beneficiary would get this $1.3 million tax-free, and they can set up 2 college funds for the kids, 200,000, 100,000 each, pay off the mortgage, pay off your $50,000 of debt, and still have 10 years of your salary, annual salary, to live on. So you don't have to work for the next 10 years, right? So that's why we use the number 10. And when I first learned about this die method, I said, it's just so simple, right? This stuff should be taught in school, but it's not. And most people don't even know about it. They think, 100,000 from work or $250,000 from a state farm policy or whatever, right? Any company is enough. And it's not enough, right? So this opens up their eyes. Usually the reaction I get is, wow, that's a lot. But when I explain to them the whole process, right, how the die method works, I said, does it make sense? And they said, absolutely, right? And I always ask the question, I said, well, you own the home, right? If your home is worth $500,000, would you ever insure it for 250,000? No, right? You would never do that, right? So it's critical that you have enough life insurance coverage. So then I come down here, I'll say, there are 3 options as far as buying life insurance, right? You can buy a term insurance only. You can buy a permanent insurance policy only, or you can have a combination of term and permanent insurance, right? To get you the total $1.3 million of coverage. And by the way, there's a general rule, right? Coverage usually cannot exceed 20 to 30 times your annual income. That's usually the life insurance company's guidelines. All right. So pretty straightforward. And after this, I transition over and I say, now let me teach you how life insurance works. Then I go over to my second worksheet. And this is with the help of Albert. Albert used to do this, and I just took his ideas and just put it on a worksheet, right? So here I say, Mr. and Mrs. Client, let me teach you how life insurance works. There are 2 kinds. First one is term, and the second one is permanent. Let's talk about term insurance. Term insurance is like renting a home, right? That's the analogy I use. And I would say, well, let's just say you buy a policy for $1 million, $1 million term. Well, term insurance is temporary. It doesn't last the rest of your life, right? Just like renting a home, okay? And you can get a term from 10, 15, 20, 25, 30, 35. And I've seen some companies that will protect you up to 40 years, right? And if someone were to pass away within the term, then the family gets a big check, right? Gets a death benefit. However, if they passed away, if the term has expired and they pass away after the term has expired, then there's no longer any life insurance, right? So the family will not get a death benefit in this case. So it's temporary. But what are the pros and cons? The advantage is that it's very affordable. right? Low cost for a lot of coverage. And premiums are usually fixed for the whole term, right? Unless you sign up with some of these other companies that offer increasing term policies, which means like every 5 years or so, or it could be every year, where your premium goes up. I don't like those, right? And number three, and we have Corebridge, right? One of our providers. They actually offer living benefits as well. So what are living benefits? Living benefits means that if you were to have a chronic, critical, or terminal illness, you can get a check while you're still alive, right? So there are two kinds. There's the generic kind where there are no living benefits, right? The client would have to pass away before the family gets a death benefit. But with living benefits, you can get a check, right? If you have a chronic, critical, or terminal illness. Now, what are the disadvantages with owning a term? Number one, there's no cash value. Never any cash value with term policies, right? And coverage is not for life. We said that, right? It's temporary. And if you were to renew it later on, so, if you bought a 20-year term today and then, 20 years from now, your term has expired and you want life insurance again, right? You want another policy. Well, that policy is going to be a lot more expensive because you're 20 years older and then your health could have changed, right? And that, that's not good for as far as premiums are concerned. So that's how I explain the term insurance part. Then I transition down here. Then I would say the second type of life insurance is permanent life insurance. And it has two parts, right? And then I go down to this little drawing here. I said, for example, you may pay $100 a month in premium. Well, as an example, right, one part, you may pay $30 for the cost of insurance and fees. And then the remainder, the $70, would go into a savings account, right? So all permanent life insurance have a savings account built in, and it grows yearly with interest. All right. And then to come back up here, and I would say, so life insurance is owning a home, right? There's a savings component to it, right? You're building value, right? And with homes, you're building equity, right? With life insurance, you're building cash value. And let me walk you through the different types of life insurance policies that we offer, and starting with the oldest type. The oldest one is called whole life. And it's called whole life because usually you're asked to pay a fixed premium for life, right? And usually to age 95 to 100. And depending on the insurance company, they would offer you a fixed interest rate. And you can earn anywhere between 1 to 3.5%, right? Some companies offer a little bit more, but generally around that range. Now, what's the problem with whole life, though? Whole life is generally very expensive, right? And in this part right here, I think most people don't like whole life is because you have to pay for the rest of your life, right? So companies, the insurance company, they came up, they're always evolving, right? Come up with new and better products, and consumers want it better. So then they came up with universal life policies. Now, if you remember, if you're licensed, if you remember studying for your life exam, right? What does the word universal mean? It means flexible, right? Flexible premiums. It means that if you lost your job and you had cash value inside your policy, you can stop making premiums. And the premiums can come out of the cash value, right? So you don't default, you don't lose your policy. Whereas with the whole life policies, if you skip some payments, right, you can end up losing your policy. And as far as the interest rates are concerned, the amount of interest you earn, it's around 3 to 4% these days. Okay. Well, we know that as far as investments are concerned, right, earning 3 to 4% is really not something to celebrate, right? To to brag about, because that's barely keeping up with inflation. So again, right, consumers wanted more, and the life insurance companies came up with a better product, in my opinion, right? And this is something I personally own, an index universal life policy. So the way, again, universal means flexible premiums. So you have that, right, built into the policy. And interest rates over the last 25 years, right, index universal life policy has been around, I think, from what I remember, started in like 1997. I think that's one of the first policies that came out. Well, over the last 25 years, it's been averaging about 7 to 8%. You would have earned on average about 7 to 8% interest, right, on the money inside your savings program. Now, the interest that you earn is linked to the performance of the stock market index, right? Hence the word index universal life, right? Like the S&P 500 and other indices. It's linked, which means that your money is not invested in the stock market, right? So if your money is not invested in the stock market, that means you would never lose money here, right? So it's always, your money will always be growing, right, from year to year. Now, some years you may not earn anything, and that's because some insurance companies, what they do is they'll offer you a range, right, a minimum and a maximum. So, or you might hear the term a floor and a cap, right? So some companies will offer you a minimum of 0%. That means no matter what happens to the stock market, right? If the stock market is down, is negative, you'll earn zero, which is fine, right? You didn't lose anything. And could be up to a maximum, a cap of, for example, 12%, right? That means if the stock market goes up 20%, you're capped, right? You're limited to 12. But 12% is pretty good, right? Yeah, without any risk. And in some cases, some life insurance companies offer products where they offer you what's called a participation rate, right? That means you get a percentage of the performance of the stock market. For example, 80%. So let's go a little deeper here. So in 2020, the S&P 500 gained 16.3%. And if you have a product, right, if your life insurance policy has a participation rate of 80%, for example, you would earn 80% of 16.3%, right, which comes out to be 13%. And that's how much you would earn for that particular year, right, for 2020 in this example. Not bad at all, right? I tell my clients, anytime you're getting 10% or more, that is a good return. Right? Now, if you have policies that offer a floor and a cap, right, a minimum and maximum, like this right here, like this example, minimum of 0%, maximum of 12%, right? And I just got some data off the internet, and these are actually from the S&P 500 company, right, from their actual website, and to get these real numbers. So in 2020, again, right, the S&P 500 gained 16.3%. Well, if you have a cap of 12%, how much would you earn? Right, and I would ask the client. And you get 12%, right, because that's the max. 2021, even better year, right? S&P 500 was up 26.9%. What would you get? You capped, right, at 12%. You got the max, which is fantastic. And in 2022, market had a big downturn there, right? Lost 19.4%. So what would you have earned that year in 2022? Well, in this case, remember what I said? You never lose. So you earn 0%. Zero is your hero, right? You're pretty good. So at this point, I'm done with this worksheet, right? And then I asked a closing question. I would say, well, Mr. and Mrs. Klein, based on what I just shared with you here, which one interests you the most? And you know what most of my clients would say? They said, I really like this IUL, right? And then is at this point, I go to illustrations. I'll say, okay, fantastic. I love the IUL. In fact, I own one myself, and I have one for my daughter, right? Little bit, personal testimony there. And then I go and run illustrations. But keeping in mind, right, how much does the client need, right? In the example I showed, 1.3 million, right? So when I'm done, I want to make sure that I'm offering solutions, or either it's all term, or it could be all permanent, or a combination of term and permanent insurance, where the client's going to end up with 1.3 million. Because I'm not going to sleep well at night if the client is underprotected, right? Okay. So that's how I walk through these two worksheets every single time. And usually at the end, right, we end up writing business because the client understands it very well. And when I show them the numbers, right, run through the illustrations, they get excited. And then when they finally sign the application, you can see the relief, right? They feel so much better. It's amazing feeling. And I walk out of the client's home, right, feeling, like $1 million because I did my job, and I know that I just protected another family the right way, right? And how many times have you seen clients, with policies that are not suitable for them, right? Not enough coverage. So make sure when you go out, right, make sure you help them get the right amount, and also the right kind. All right, lastly, I want to share my third worksheet, which I call the investment barometer. Again, I give credit to Albert because he used to draw this on the whiteboard, right? And it took a long time. And I said, nope, this is a perfect example for another worksheet right here. I know there's a lot of stuff going on, right? But a picture is worth 1,000 words. So let me explain. Let me show you how I explain this to the client. How many times have your clients, would say something like, yeah, I have a Roth IRA. Can I lose money in a Roth IRA, or isn't a Roth IRA a mutual fund or something like that? And that tells me, when they ask me questions like that, that tells me that they're a little confused, right? About the difference between an investment vehicle and the engine. So I'll start down here. So the IRS has some investment vehicles, right? Gives us opportunity to invest in investment vehicles, but they set up certain rules for that. And you've seen these before, right? The Roth IRA, traditional IRA, rollover IRA, SEP IRA, simple IRA, 401k, 403b, 457, 529. These are tax codes. These are just investment vehicles that allow us to save money, right? But there are tax consequences depending on how you, right, you deposit the money and take out the money later. And also whole life, universal life, IULs, VULs, etc. These are also governed by IRS rules, right? You've heard of the tax code 7702, right? That refers to the treatment of taxes inside life insurance policies, right? Now, so you have this car, right? This IRS car, right? IRS vehicle. But when you buy a car, right, usually you have different engines to select, right? If you buy a fancier car, you can get a 4-cylinder, you can get a V6, you can get, right, certain different models, right, different features to it. So now, what are some of the investment engines that are permitted by the IRS? These are checking accounts, savings account, CDs, right, fixed annuities, fixed index annuities, other fancy investment vehicles, variable annuities, mutual funds, stocks, options, money market bonds, right? So getting really technical here, but these are all permitted, right? To put into these IRS vehicles, but they're not all compatible, okay? And I'll show you some examples in a second. But let's come right back up to here. I call it the investment barometer. And this just gives you a good idea as far as what's the amount of risk involved for each type of investment, right? Let's start off with this right here. On the left side, you have zero risk. When I say zero risk means you don't lose any money, right? So what are some accounts, investment accounts, where you don't lose money? Well, you have your checking account, right? Your savings account and your CDs. And all of these are FDIC insured up to $250,000 per bank account, right? So you don't lose a penny here with these types of accounts. And they have zero risk, right? Now, as you move to the right, you're going to gain more interest, right? There's more risk, more reward also comes with more risk. So here, right, these three investments here, accounts, they don't have any risk. But also, how much interest do you earn, right? What's the rate of return on these three? Usually pretty low, right? So there's no free lunch. If you want a higher return, you have to take on more risk. So as we move to the right with more risk, right, you get higher return. And you got fixed annuities, they're still green, right? Fixed index annuities. These by definition offers, right, they have zero risk. Come with higher return, usually, right, than the CDs. And with fixed index annuities, now your rate of return, it depends on the index. So you can get some good returns out of them, right? Then you also have the IULs, which also has zero risk, right? You don't lose any money in your savings account there, right? Oh, my time is coming up, but I'll wrap up in a minute here. Then you got your money market, right? Very little risk, but very minor, right? And you can get some, depending on the market conditions and the interest rate environment, right? You can still earn some decent returns. Then bonds are generally safe, but again, there's some risk there as well. Bonds can still lose money. There's active money management. That's when you have money managers that's supposed to watch your money and just keep on top of things. So they take on some of the risk and just watch your money better in theory. And then you got mutual funds, right? Which is these are big buckets of stocks, right? A lot more risk involved because now you're dealing with a stock market. Variable annuities, these are annuities where you're pretty much investing in mutual funds, right? VULs, these are variable universal life policies. Again, you're investing in the market. And then, of course, stocks and options, they're just a lot riskier. So this it's been a very good worksheet for me. Clients like it. And usually they get a lot better understanding, right? The difference between IRAs and between the cars, the investment vehicles, and the engines. And then here, not all engines are compatible with all investment vehicles, right? And these are just examples. So mutual funds, you can put them inside 401ks and college plans, index crediting strategies, IULs, right? Fixed index annuities. And then as far as Roth IRA and traditional IRAs, you have a lot more options to do. All right. So I'm going to stop right here. I will share these in the chat. So feel free to use them. I hope you got some value out of them this morning. And let me know how much money you make using these worksheets.
Richard, man, great job. Everybody give Richard a hand. Was that awesome?
Fire. That was
Great
Awesome.
job.
my
Great job,
goodness.
Rich.
That was
That was amazing.
job.
Thank you so
Wow.
much. Good job, y'all. Awesome job.
Thank you
Incredible.
so much for this. From
Yeah,
the
that was
car.
exciting. Exciting.
All right,
Thank you,
good.
Rich.
So Rich, somehow this is not my Zoom, so I don't know the settings and it didn't allow me to share the sheets on here. But Rich, a lot of people want these worksheets. I don't know, Jackie, should you just hand them to everybody, or should we, like, if you go get one client or one recruit, maybe we'll give you the worksheet, because most people are gonna print it, put it in a folder. They're never gonna use this, right? We need this We'll let Jackie decide.
I'm gonna use it right now.
All right, LJ's ready to go. So, by the way, look, stuff like this really helps, right? So, like the term versus permanent worksheet, right? A lot of people don't realize that they're underinsured, or the dime, right? The dime worksheet, right? They're underinsured. And you gotta, everybody, you gotta use analogies that are simple that people understand, right? Like, would you buy an insurance policy for your home that only covered the kitchen in case your house burned down? Most people would say, well, no, I would want the whole thing replaced. Say, well, with your life insurance, you're only covering your funeral, not all the other stuff, right? That's the dime method. Then what I like, we call it the Franklin T, right? Term versus permanent. Now you're giving people education about what their choices are. The problem is sometimes somebody comes to their home and they get pitched on insurance, right? Nobody ever asks them questions or what type of policy they would want. They just say, here's the one for you, right? Imagine walking into a car dealer, right? And you haven't talked to a salesperson or anything. They're like, hey, come over here. We got a car for you, ready to go. You're like, you don't even know my needs, right? So that's why sometimes people get a bad vibe about insurance agents and stuff, because they're just pushy, they're trying to sell me stuff. But when you educate someone on the choices, interestingly enough, when you do that presentation, 95% of people, when you ask them based on term and all these permanent policies, which would you prefer, everybody says IUL, right? And I saw in the comments like, oh, I love IUL, I love IUL, but should everybody have an IUL? I don't believe so, right? Because it might be a good product, but you might have them underinsured, right? What if the person's need was 1.3 million, but based on affordability, you sell them an IUL for 100,000? Did you do your job as an agent, right? So it would be like somebody coming to a car dealer and saying, hey, it's me, my wife, we got 2 kids, right? We need a vehicle. And then the salesperson sells you a Corvette. What's the problem with it? That's a 2-seater. It's not a 4-seater. It doesn't address the need, right? You might want the Corvette because it's nice, it's stylish, it looks fast, it's sporty, but you're like, look, I know you want that Corvette, but right now you need a sedan or you need an SUV. You got different needs, right? So it's our job as professionals to be able to assess that, right? But work with your clients, get them involved, right? Ask them questions. What do you know about this? What do you feel, right? And then with the Javier here, with the investment barometer, right? I love that because I used to confuse things so much in my head, and that's why I was so intimidated, everybody. Like, for example, I used to think 401k was an investment, right? And then until somebody said, no, that's just like a tax code. The investment is like a mutual fund or a stock. Like, so let's say somebody worked at McDonald's, they can put in their 401k McDonald's stock, but there's some risk to that, right? Because all your money is in one basket there. Or you can use a portfolio of mutual funds, right? And then there's more diversification, but there's still some risk. And I'm like, oh, wait a minute. So the 401k is not the investment. That just sets the rules, right? Who can contribute? How much they can contribute? When can they take the money out? Is the money taxable? Is it tax-free? Is it like all those parameters are set there? So I'm like, wait a minute, this is not that difficult. And by the way, a lot of clients get confused. I'll give you an example. One of my last clients, I asked them, do you have any old 401ks or old IRAs that you want me to take a look at? And she says, I have an IRA at my bank. Okay, IRA, remember that's the vehicle. Where do they go to set up the IRA? At the bank. So I'm like, all right, tell me about your account, like your investment. She's like, well, I really don't know. So I'm like, can you get a statement? Okay, client goes and get a statement. And I won't name the bank, right? But this wasn't a big balance. So do you think the client got to talk to one of their advisors? Nope. They got to talk to a teller who put them in front of a bank representative who says, oh, you need to open up an IRA because the money came from a 401k. So the 401k had to go into an IRA that's called a rollover. And we're going to put you in this product, right? Guess what the product was? The engine. A savings account. This client's in their 30s, right? So the client, I said, how did you go to where did you just walk into the bank or how did you find out about? She's like, no, my tax preparer. I went to my tax preparer, asked my tax preparer, what should I do with my old 401k? The tax preparer said, you need to roll it over into an IRA. The client's like, well, can you help me with this? The tax preparer says, no, I only do taxes, but you can go to the bank. They can help you there. So the client goes to the bank, rolls over their 401k like they're supposed to, so there's no taxes or penalty. But what kind of engine did they just put on that account? A very slow moving engine. That thing's not going to go anywhere, right? So if somebody did the right evaluation, that client may be a candidate for an indexed annuity. Maybe they need something in the stock market. They're in the right vehicle, but the wrong engine. Imagine having a Ferrari, April, and you're driving it on first gear the whole time. That's not how you drive that vehicle, right? And with insurance too, people have whole life and universal life. I'll say, how did you determine that? They're like, well, they bundled it with my home and auto, so I got a bundled account. And I'm like, that's not how you buy insurance for a discount. Like, they didn't do an evaluation, right? That's why you have a universal life, or you have a whole life and you don't know. So it's confusing for the general public, right? How all this stuff works. It was confusing for me as an agent. But you know what I figured? Once I learned this puzzle piece, I'm like, I want to be rich. Because most people don't understand this stuff. If I get it and I understand it, I just got to communicate it with people. And if you've ever had children, right, small children, there's that little game that they have with the square, the triangle, the star, right? What happens the first time they play with that? They're trying to shove the circle in the triangle, right? And they're trying to do the square and the star. It doesn't. But after a while, what happens? They're like, okay, circle, circle, triangle, triangle, and they get bored with that toy, right? They're like, I got to move on to another one. This is too basic. Well, guess what, everybody? Finance in the beginning, when you're new, it feels like that toy. You're trying to put the star in the square and the triangle in the circle, and it's a little confusing. But once you have a way to break it down mentally, right, you're going to be just fine. And you're going to know more than 95% of people out there, because most people don't understand the stuff that you just learned this morning from Rich. So we'll get Rich, maybe figure out how you can share that information, put your email there, or you might get bombarded though. So warning, but Rich is great, by the way. He's always willing to share. And, you know, I'm glad you guys to get to hear from him. So, all right, let's talk about the next step, referrals. Okay. So a couple things, mindset. Let me tell you a mindset, working with clients. Okay. This is very important. I have people debate me on this, and I try to always win on those debates, right? But here's a mindset. I never thank my clients, okay? I never thank my clients when I help them, okay? Never, right? I always say, I'm glad I was able to help you, right? April, I'm glad I got to meet you. I'm glad I was able to help you put together some financial programs and stuff like that. I'm excited about your future, okay? Think of this, right? If you had open heart surgery, right? If you just had open heart surgery and the doctor came in after you recovered and you survived, wouldn't it be weird if the doctor thanked you, like, hey, thank you for using our hospital and allowing us to, you know, do surgery on you? Wouldn't that be kind of weird? Like the doctor thanking you, like, hey, or wouldn't you as the patient be like, thank you, doctor, you just saved my life. I'm going to tell everybody about this hospital and how you guys were awesome and amazing. The nursing staff was the best, right? It should be the client thanking you, not you thanking the client, right? So build a little bit of a mindset around there. You're spending time here on Saturdays and maybe throughout the week and logging on trainings and educating yourself, going to classes, spending money, getting certifications, right? Going to big events, right? People should be grateful that you're putting in all this time and effort to learn something, because you can bring a lot of value to them, right? Whether you're new or a veteran, right? If you're new, you can introduce them to a veteran, right? And learn along the way. And if you're a veteran, right, keep doing what you're doing. Now, here's when I do thank people, whenever they send me a referral. Okay, if somebody sends me a referral, I'm always like, hey, thank you for introducing me to your niece. Thank you for introducing me to the person you care about. I was able to help them too, right? And another thing about referrals, and I'm gonna give you a visual here in a second. I used to be bad at referrals. I would do a couple things like this. I would either carry a worksheet like this and I'd leave it. I'm like, hey, by the way, if you know someone, write their name down and let me know. Guess how effective that referral system was? Sometimes somebody might be like, hey, I got this for you. I got one name in there. And then I'm like, okay. And then I call and usually they hung up on me or something like that. It's like, man, this is frustrating. Right. Then I was afraid to ask. Like it's just such an easy thing. Now, but in the beginning, I don't know why I got like nervous around asking for referrals. Right. So I didn't have effective methods. But here's what I've learned over time. Okay. Number one, if I help someone, if Richard was my client, right, I might say, hey, Rich, how was your experience with everything? Like everything you learn, hopefully it's a good one, right? Like, man, this is great. That tea table you showed me and the investment, I mean, I've learned so much from you, right? Albert, this was great. Awesome. Rich, is there anybody that you care about in your life that needs to see and have that same experience? Okay. I use the word experience. And would you be willing to introduce me to them? Just make the introduction, right? Now, you have to coach your clients on how to refer you to people. Because if you don't, I might say, hey, Richard, if you know let's say Richard bought an IUL from me and he's paying $900 a month, right? Because we talked about it, we structured it properly. And I'll say, hey, Rich, if you know anybody that you want to introduce me to, please do so, right? So Richard hangs up with me. He calls his best friend, Jose, right? Says, hey, Jose, do you want to buy an IUL? Right? Scenario of disaster. And Jose's like, what's an IUL? Oh, it's like this insurance thing. He's like, insurance? How much are you paying? $900. Like I'm putting 900. You know what's going to happen? Jose's going to talk him into canceling it. He's going to be like, I got mine at State Farm. I paid $50, right? Like, what are you doing paying $900? Somebody took your money. And all of a sudden, Richard is having doubts about me, right? When his experience was real good, right? And why? Because Jose wasn't there. Jose didn't see the overview. He didn't see the presentation, all that other stuff, right? So what I would tell Richard is like, hey, Richard, you know what? You mentioned Jose. He's a good friend of yours. Tell him about your experience. Don't get into the details of what we did for you because his situation might be a little different. Just tell him maybe some things you learned and picked up from me, right? I hope I wasn't pushy, or I hope you appreciated my service. And if you can make that introduction, it'll be very helpful. Now, let me draw this out real quick. Show you this one little thing here. It's a little ping pong game that you got to get good at. Okay. So here's Richard and here's Jose. So Richard makes the introduction, right? So I go meet with Jose, and let's say Jose has a good experience with me too. I don't know. I helped him roll over some money, and we set up a term policy for him. He's got living benefits now. He's got some college plans for his son. So he's pretty happy. Okay. What I always ask is I ask this person here, hey, Jose, do me a favor. Okay. Can you do me one big favor? Jose is going to be like, yeah, sure. Right. Can you call Rich and just share with them? So call him. You just share with them your experience. You don't have to get into details. Just share with them, what you learned, or, hopefully I brought some value to you and everything like that. Okay. And Jose is like, absolutely. Yeah, I'll call Rich. Why do I need Jose to call Rich? I don't need the answer. Here, I'll give you the answer. Because I want Rich to know that I did a good job with his friend Jose. Because here's what I've learned about people. There's referrals and there's the real good referrals. Okay, there's a referral like, hey, here, talk to my friend. And then there's like people's hot market, warm market, right? I need Richard to understand that anybody he introduces me to is going to have a phenomenal and a great experience. Why? Because if Richard starts getting out good feedback, then he's going to say, hey, Albert, you know what? I need you to call my mom. She has $500,000 in her 401k, and you've been helping everybody. Everybody seems to love you and have a good experience. Let me introduce you to the people with the big money, right? So I'm willing to take all referrals, right? Even if it's like an 18-year-old, $50 a month, whatever, because I still want good feedback coming over here, right? And I wait a few days. So I asked Jose for a favor, do me a favor, call Richard. I wait a few days, right? Let's say it's 5 days later. Then I call Richard. So Albert calls Richard. And my call is something like this. Hey, Rich. Hey, I just want to thank you for introducing me to Jose. I went over and I was able to help him with some things. And here's what usually happens. Rich will say, you know what? Yeah, he called me and he was so fired up and excited. He's happy. He had a great experience. I would hope that already, that the phone call was made. And I'm like, yeah, absolutely. Look, if there's anybody else that you know that would benefit from what I taught you and Jose and would like to learn more about money, keep me in mind. I'll put all your referrals on top of my list, right? I'll make sure they go on the top of the list all the time. And you know what happens over time? You generate a business where there's a lot of incoming phone calls to you, and you don't really have to go outbound and try to figure out like, where am I going to get my next client? Okay. But you got to play that little ping pong back and forth with individuals and have an emotional attachment. By the way, ask the right questions. Richard, who do you know that would like to retire early? Not, Richard, who do you know that has a 401k? Richard, who do you know that would like to afford, maybe college for their kids? Do you know anybody with small children? They would like to learn how to afford college for their kids? Yes, I know so-and-so. Make a connection, right? And when you make a connection, leverage it, right? So if I say, let's go back to just keep Richard Jose as an example. He says, you know what, my friend Jose, he's got a son Isaac. He's, I think, like 8 or 9 years old, right? He would love to. I think he would be interested in learning about college for his son. Then I'll do something like this. I'm like, Rich, can I show you something real quick? Close that. Here's the emotional connection. Oh, I don't even know if we're running out of time. Maybe I'll save this for like 3 months from now. No? All right, I'm gonna go to Google. By the way, share this with people. Share this link with people. I always have people add it to their home screen now. I'm doing it more often. Like the Corebridge calculator. If some of you were on that training, you can add it to your home screen. You can add this website to your home. You add it to your home screen as an agent, but take it and show people how to use it, right? Because if somebody learns how to use it, they're going to share it with other people. And then the person's going to be like, well, who do I talk to? They're going to think of you. You want those referrals coming in. But I'll be like, hey, Rich, let me just show you something real quick. This is before meeting Jose. What if Jose met with me and I don't know his situation, but what if he started putting away $100 a month for, what was his son's name? Isaac? Okay, Isaac, $100 a month. And if Isaac's around 10 years old, he's got 55 years before he's 65. And if we invested it properly, I'll meet with Jose and figure that stuff out. But let's say we got a 10% return on that money over those 55 years. Look at this. Little Isaac would have $2.2 million for retirement if we got him going right now. If Isaac doesn't learn this till he's 25 and we lose 15 years, look what happens. Poor little Isaac only has $500,000, right? By the way, then I'll say, Rich, how would Jose feel about you that you had this information and you didn't share it with him? Oh man, he wouldn't feel good. Introduce me to him. And by the way, I promise this, if we get something going for Isaac or whatever, I'll let Isaac know when he gets older that it was because of Uncle Richard, right? That he's now a millionaire, right? Because Richard made the introduction to Dad, and then Dad got some things going, right? But you were the person that originated this whole thing to change his whole life. Wouldn't that feel pretty good, Rich? Good. So now I'm tugging a little bit at the heart. By the way, it's not a tactic. If you do it as a tactic, people are going to read into it, right? I'm doing it genuinely because I want people to have a better financial life, right? And if Richard doesn't introduce me to Jose, I don't know if Jose has an advisor or he's going to go to the bank and he's going to use the wrong vehicles, right? Somebody's got to go out there and educate it. I'm passionate about that, but I need that introduction. And guess what? If Rich feels good about that, do you think I'm going to get more referrals? Absolutely, right? And it just keeps going and going and going type it in on the Vantage calculator, how much money you can make if you're helping consistently 4 to 5 clients a month on your own, right? Your brain's gonna explode, right? Then if you build a team and teach people how to do this, you're gonna make a lot more money. And you never have to go get a 9 to 5. You can, for 26 years, I've never punched the clock. I've never had a boss, which is awesome. I just became pretty good at building relationships, asking for good referrals, making an emotional connection, right? And I've never had a problem with staying in business or having to go get another income because I'm not doing well here, financially. So, all right, with that, we're gonna end there, but I got some recognition. Dan was kind enough to send me this. I hope you enjoyed some of those tips and pointers. Please apply them into your business. That's anybody that ever does a training, or whenever I do a training, I love hearing, not that the training was good. I love hearing, hey, I took what you said and implemented in my business and it made a world of difference. I'm getting good results. Thank you. And that's, people that train, they love that there. So let's view this. We're 1 week in. Slideshow mode. I'm going to read off some names. And here we go. Let's go personal production. You can unmute yourself and cheer.
All right, let's go.
Let's go.
Yang Bang, number 10. Jesus Macias on our team, number 9.
Mariana.
Congrats, team.
Let's
go.
April.
Yeah.
Hold on.
Let's go.
Baby.
Yo.
Let's
Job.
go. Let's go. Whoop, whoop, whoop.
26,000.
Good team.
Okay,
Juliana.
Juliana.
Wow, that's
Congratulations,
awesome.
Juliana.
Job, Juliana.
Wow.
All right, here's the builders. Martin Grajales, Brenda Lee, Rachel Bishop, Laura Bain, Aguirre, sorry if I'm hacking up your name. Eric Matos organization. Congrats, Eric. Derek Shaw. Sean Shelton. A lot of people tied at
Wow.
four.
Way to go.
All right, Jack.
All right.
There you go, Jackie. Great
Go,
job.
Jackie.
All right, 14 points. Cruz Macias on the leaderboard.
Let's go,
Love it.
Maribel.
Maribel Cardona. Chris Walker.
Awesome.
Rob,
April.
Very comments.
There with the David.
Jay Scott.
Mariana.
Way to go, team.
Awesome. Congratulations.
Julio Herrera.
Great
Great job, Julio.
job.
All right, core team recruits. Jennifer Lewis, Danielle Manson,
Let's go,
Brandon.
Come on,
Good job,
coach.
Ashley Gary, Eric Matos. I love seeing new names on here.
Great job.
Eric Sean, Derek
Great
Sean,
Good team.
Dave
Hi,
Bond.
Okay, Shay.
Number 1, Jackie. All right, frontline points. Adriana Ortiz, Apris
Let's go,
Walker, Barrett
April.
Cummins,
April.
Lisa Manelli, Ruben Gomez,
Andrea.
9 points.
Ariana.
and number 1,
Hey,
David Hemmington. Congrats, David. Builders, Jennifer Lewis,
David.
Trey Turner.
Oh, Jennifer,
Jay Scott, Derek Young,
Hey, Trey.
Dave Bond.
Let's go, Shay.
Way to go, Shay.
Let's go, Shay.
Timothy, LJ Park.
All right, LJ.
LJB.
Jackie,
Knocking them out.
Tire Team Production, Barrett Cummins, and Lisa.
Let's go.
No, and all that guy, Ruben, Jay
Let's
Scott,
get it.
Julio
job.
Morena, Daniel,
Yo.
Great Scott.
Mariana Martinez.
All right,
David.
And Mariana.
Number 1,
This is amazing.
Andre.
All right,
Andre.
Andre.
Here we go, Tire Team Recruits.
Wow,
Pop
loving this, everyone.
Dan Ebert,
Congratulations.
Timothy, Laura Vane,
Laura.
Andre Genovesi, Jackie Ashford.
Good job.
Andre.
Good job,
Let's
everyone.
go, April.
April.
Hey,
Number 1,
LJ.
Andrea
Great
Cerveza.
job.
There. Oops.
Whoa, that was too
There's a
fast.
cycle of the week. Juliana, 15,000 bucks. All right, we're gonna hit you up from below.
Go, Juliana.
Way to go.
Qualified R&D.
Oh, April. Yes.
Go, April.
Qualified FEC. Andre Genovesi.
Come on, April.
100,000
Come on, April.
Green number 1. Congrats.
Let's get it.
Yes.
Flynn and Jack's
Good
Cameron.
job.
Congratulations.
Get it.
Team 2. you.
Paradise.
Registered. You
Jack.
don't want to be in the
Yes,
States
let's go
in
tomorrow.
March. It's still cold here. And there you
go.
go, everybody. Hey, implement what you learned. Go get some referrals. Go educate some people. Richard, did you put?
Yes.
Did he put in there how to contact? Okay.
Yeah, and I
You need
put
to
the,
get a hold of those
I put a
worksheets.
link to my Google Drive.
Perfect. Click on that link. You have access to it. And man, you did a phenomenal job. Let's go out there and get some people educated and informed about what we do. Let's create some great relationships, make sure people have great experiences, and go build a massive team. All right?
All right,
Take care, everybody. Have a great
Thank you,
week.
Richard and Albert.
Training, guys. Thanks, Albert.
Great day,
Thank
everybody.
you. Good day,
Thank you.
everybody.
God bless.
Thank you.